Election Investor Climate. I'm Ron Loch, Managing Director of Sustainability Consulting for GNS Business Communications. We're a full-service communications agency with a focus on using insights and analytics to guide impactful sustainability communications. Before we get started, I'd like everyone to go into the poll question we have down in the right-hand corner of your screen and let us know if your company is currently reporting on ESG issues. That box will also be where you find our question and answer box. As we go through the presentation, if you have any questions on your mind, please put them in that box and we'll get to them at the end of the presentation. Also, if you run into any audio or technical questions, you can also put that in that box and send it to us, and we'll make sure that those are addressed in a timely manner. If you wish to expand your screen, look for those bursting arrows up in the right top-hand corner and select that, and your screen will get bigger. And lastly, I just would ask if everyone who is calling in, if you could just please mute your phone so that we minimize the distractions for all of our listeners. With that, I'd like to welcome our guests today. I have with me Susan Sheehan, Vice President of Sustainability Consulting for GNS Business Communications. Susan is an FSA Level 1 SASB candidate with an MBA from the Richard Ivey School of Business. Susan helps organizations evaluate and benchmark their ESG performance and guides their communications so it resonates with investors, customers, and the general public. Thanks for joining, Susan.
Hi, nice to be here.
We also have with us Greg Elders, Bloomberg Intelligence ESG Analyst. Greg has more than 15 years of experience valuing environmental, social, and governance issues. He has a master's degree from the London School of Economics, and his research efforts include climate change, stranded assets, extractive industry safety, water scarcity exposure, and governance issues. Thank you for taking the time out of your busy schedule to share your insights today, Greg.
Thank you for having me.
And thanks to our audience for taking the time during this hectic year-end to join our webinar. Many of you are likely looking at 2016 reporting. If you're not in the middle of it, you certainly have it on your mind. And with that, we know there comes a degree of anxiety. Many of you are wondering, if your existing investors are finding the information they need. Are you attracting new investors who may become interested in your company? And also, in the end, all that blood, sweat, and tears, is it all worth it? And sorry to say, when it comes to environmental, social, and governance issues, when you look through that lens and the increasing importance that investors are placing on it, the answers to these questions are not what we'd probably like to see. Most of the research is going to show that you're probably not giving all your investors everything they want. You most likely are missing out opportunities with new investors. And in the end, while your time isn't wasted, obviously, it could be a better return on all that effort. The reason I say this is because when you look at the analysis of reports, and SASB did an analysis of more than 700 annual reports, 2015 financial reports, and found that a vast majority do address environmental and social risks, and we're finding that among our audience today as well. Almost a similar number of our audience are reporting on ESG. The issue, though, is that more than half of those reports that were analyzed, what they found was that the language is basically boilerplate, very generic in nature. And as a result of that, you have less than a third of your investors trusting that information and certainly demanding, more robust information. And even if strategy is provided, what we're finding is a disconnect between the importance that executives are placing on that information, thinking that the sustainability approach surely shows a competitive advantage for the company. When you look at institutional investors who really use an ESG screen to evaluate investment opportunities, you have only 14% agreeing that there's a competitive advantage. And so there's a great disconnect right now between what executives are seeing and what investors are demanding. Now you might say, what about in this climate after the election? We have Trump coming on board. And in fact, I find it interesting today, 2 news items caught my eye. One is that there is a push to get disclosure by companies on their climate-related risks. The other is that the Trump administration wants to defund the NASA department that looks at earth sciences. And that group is the primary source of climate science and predictions. And so you could see where you have executives in particular who think, you know, we have a competitive advantage and our sustainability reporting is just fine, and in this new government climate, there may be less emphasis on ESG. And so is there really a need to put a lot of effort in our reporting around ESG? Greg, I'd like to throw it to you. You know, what are your thoughts and the thoughts of Bloomberg as it pertains to the post-election environment and what impact that may or may not have on the need to report about ESG issues?
Yeah, no, I think clearly there might be less policy support going forward for issues like, you know, one of the things that a lot of sustainability investors have been pushing recently is to get the SEC to support more disclosure from companies. I think it's safe to say that that might take a back burner. But I think on the flip side, you know, investors are still demanding this information. I think the same investors who were demanding before, if anything, are going to be even more insistent that companies report it. So I think that pressure is still going to remain.
And Susan, what are your thoughts?
Well, I think, you know, it's a bit of a coincidence that we're running this seminar today when the Financial Stability Board just released their recommendations. And Financial Stability Board is a global regulatory body, and they've just released their recommendations that asset owners really need to take control of climate-related disclosures from its investees. And they've laid out a series of 7 specific steps that they recommend asset owners take. So they sit at the top of the investment sort of food chain, and I think we can expect that these recommendations are going to take some force. They're not going to be embodied in any regulation. They are involuntary, but they will be presented at the G20 in July as final recommendations, and we can expect that, you know, another level of fiduciary responsibility is being laid out here in the form of these recommendations. And
so
you know, nothing really changed in November 8th in terms of the risks and the data and the need for information that the market is looking for here.
Yeah, so it sounds like certainly this the ESG reporting is going to continue to be important. So it does raise the question, though, if you have, in the case where we have 80% of CEOs who are disclosing sustainability strategy, feeling like it, you know, it's communicating this competitive advantage, which you would say then communicates value to investors. And you may have, you know, executives who feel like it's less important now in this post-election environment. How do you, if you're responsible for reporting or sustainability communications, how do you build that business case for a more robust ESG communications?
So I would say, you know, it's really interesting to look at what's happened over the last 40 years in terms of where market value comes from. And 40 years ago is much more straightforward. It was a matter of measuring the stuff that you can touch and see: cash, buildings, fleets, tangible assets, work in progress, inventory. These things were measurable and easy to report on in financial statements, and you'd throw in a little bit of goodwill for that intangible part, and the job is done. 40 years later, we're completely flipped around, where more than 80% of the value of the market is in the intangibles, and much less so about the tangibles. So intangibles are really what's tied to sustainability strategy for the most part. If you think about corporate brand reputation and how corporate policies and cultures can impact brand, think about the skilled workforce that you need in order to compete and loyalty of that workforce, and whether millennials will choose you over a competitor based on whether their values align with your values. If you think about workplace safety and productivity, license to operate, and your relationship with your community and your regulators locally, that's all the intangible stuff that is tied to sustainability strategy and where market value really shows up now. And so it's not a surprise that, you know, in the last number of years, the interest and activity around sustainable investing has grown to such an extent It's because investors have come to understand, whether they're impact investors or traditional investors, that the E, S, and G is a way for the market to evaluate the future potential of a company, the management's ability to identify risks and manage opportunities, exploit opportunities that relate to those intangible assets. And it's also, I think, important to recognize that there's so much literature out there that debunks the whole myth that you have to lower your expectation for returns if you're going to invest with a sustainability screen. That argument has been laid to rest. You either have equal or better returns when you apply an ESG screen to your investment decisions. And that, I think, has really helped to increase the confidence of investors to use ESG as part of their decision making. And we're also seeing a really strong increase in the filing of investor proposals around environmental and social issues. And the SEC has reported that not only has there been a greater number of these kinds of shareholder proposals, but the quality over the last year or so has really increased quite markedly. And as a result of that, these proposals are getting support. And this is all about investors looking for the kind of information they don't feel they can get in the public domain to help them make the right investment decisions that they want to make. So, that's sort of looking historically at what the trend lines have been, but the question is still, is this going to carry on? And I think the announcements today from the Financial Stability Board and where that's going to go in terms of really putting the pressure on asset managers, asset owners rather, to take control of ESG disclosure with relate to climate change. We're going to see a real bounce in interest. But this is a study that Bloomberg and Morgan Stanley conducted on asset managers recently and just released this information this year, showing that asset managers who do not have a sustainable investing product yet plan to release one in the next 12 months. Not one, but maybe many. So you can see that they're responding to really strong demand in the marketplace for these kinds of products into the future.
Well, and that raises the question that we see more products in this realm that's factoring in ESG, but we're also seeing more tools to analyze companies. One of the most important being the Bloomberg terminal. And so my question to you, Greg, is, why does Bloomberg care so much about ESG and getting that information out into investors' hands?
Yeah, thank you. I mean, at the end of the day, it's the fact that our clients care. We've had this big increase in demand on the investor side, as we've seen, as well as from companies themselves to be able to benchmark their performance. And as a result, we're providing that information. I think in many respects, we're trying to lead the space, but there's a lot going on. And so we're trying to constantly innovate and keep up with what clients want to understand environmental, social, and corporate governance risks. So just a little bit of background, I sit within Bloomberg Intelligence, the research arm of Bloomberg. We have about 250 analysts, focused on different sectors, predominantly former sell-side broker research analysts or buy-side asset manager researchers. And so myself and my colleagues, we look at ESG issues that affect different companies and industries, as well as we've put together a team of regulation litigation analysts looking at issues that impact business. And so within VI ESG, we've put together a dashboard where we have the analysis that we're writing, as well as linked to key data, both company-reported emissions and performance, as well as third-party data and scores. And I'll touch upon a bit more in terms of how Bloomberg collects the data and presents it as I go through. And yeah, in terms of investor demand, this was from the latest GSIA Global Sustainable Investment Alliance report in terms of SRI, Social Responsible Investment Assets Under Management. And so we've recently seen reports out of Europe and U.S. in terms of those numbers now. I think U.S. is about 22% or so of assets under management include a sustainability lens. Europe is at a similar level, sort of a majority of assets incorporate ESG issues in their investment approach. What that means in practice varies a lot, but I think the point is clients demand it. And one of the things that we noticed in terms of the data is that, if you look at the largest market cap companies in developed markets, particularly in Europe, we see very good disclosure. Particularly, obviously, regulations matter. So in the UK, companies have to report their carbon emissions for their total operations globally. And so as a result, we have essentially complete data from all UK companies. And if you look at someplace like the US, there really is no rules on reporting for global operations. There are requirements for large installations to report it. But if you're looking at global operations, you don't have any requirements. US is sort of in the middle. And if you look at emerging markets, China at the very end there. And, I think it's one of these things where the more investor demand you have, there's a lot of demand in Europe, there is that pressure to report. And sort of going back to the issue of, how things will change post-election, that investor pressure is still going to be there. And again, potentially could even grow. I think one of the things that we've seen is, if you look at emerging markets, or Asian markets, at least within Singapore and Hong Kong, they're requiring companies to start reporting on ESG data. Hong Kong, I believe it's from next year. They have their guidance that they've reported, and then Singapore 2018, really encouraging companies on the stock exchanges to report more data. And so in terms of the data that we collect, so this is looking at our ESG analysis function. We actually launched this year, where we're pulling in the data that we collect on the Bloomberg terminal. So in terms of what information we're collecting, we're going to about 11,000 companies globally and providing this data. And we collect it ourselves. We have a team of analysts pulling out the information from company sustainability reports, annual reports from their websites. And we have about 250 different environmental or social data fields. There's both quantitative data fields as well as qualitative yes/no for policy fields. Does a company have a green building policy? Does it have a human rights policy? So we collect that data, we put it on the terminal, and so as I said, 11,000 companies globally, and so within the U.S., that means the entire Russell 3000. If you look at Europe, Stock 600, so on and so forth. So if you're in a major index, we're going to collect that data. And you can get a sort of an idea, hopefully, from that image in terms of the type of data that we have. And, we've got a lot of very good feedback from clients in terms of this function, in terms of you can very quickly see what are the issues, where does a company stack up relative to peers, relative to its history. And one of the things that we're increasingly doing is bringing on third-party ESG scores. So on the top right, you can get an idea of Robeco SAM, so the power behind the Dow Jones Sustainability Index. We have their scores on the Bloomberg terminal. Sustainalytics, we bring their scores on. ISS governance scores and CDP climate scores. So really trying to provide this consensus view to ESG performance. And so, so in terms of the third-party scores, you can see that on our Bloomberg Intelligence ESG page, as well as it filters across the different functions that we have. So basically any of our ESG data fields, as well as many of the third-party ESG scores. What a number of clients do is they can use it for their equity screening. So maybe they want to identify companies with high earnings growth, high dividend yield, and high ESG scores. So they can very quickly set up those filters to identify companies to potentially buy or sell for their portfolio, as well as make changes to their current investment approach. Filters into our portfolio analytics. So really, I think the innovation that we have, what we bring to the table, is the ability for investors to see the ESG data exactly where they look for financial information. And one of the things that we've rolled out this year is our industry primers. So we've gone through for about a dozen sectors or so, starting, if you will, the more high impact sectors, more likely to have issues to environmental, social issues impacts. And so we use the Sustainable Accounting Standards Board as our base. And so obviously Bloomberg has been a big supporter of the initiative. Michael Bloomberg is chairman of the organization. We've given them money donations to help them. And so we've taken their recommendations by industry. One, we've created a template on Bloomberg so anybody could type in the ticker for their company and see all the SASB data fields for that company based on the sector it's in, and then see the corresponding data we've been able to capture from a company's report. And then with our industry primers, we're trying to go one step further and actually really benchmark companies using quantitative data as much as possible to see where companies stack up. And so obviously, sector like oil and gas, utilities, it's very clear how issues like energy efficiency, safety performance go to bottom line. And one of the things looking at the food sector example here is, the real growth area you've seen in packaged food, it's coming from, sort of organic, healthy living. And so we're collecting data field in terms of, percent sustainably sourced. And if you look at it, so White Wave had one of the highest proportion of sustainable sourcing, and that company was recently taken over by Danone. So these sustainability trends, whether it's from investors or just sort of what's out in the marketplace, it's something that investors increasingly understand that they have to be aware of. And then just sort of going back to the point of shareholders and what's going to happen going forward, what we can see in the sort of complicated chart is, one, the white line is number of environment-related shareholder resolutions filed in the U.S. So that's been steadily increasing. And so the flip side, what we've seen is, I think, sort of as resolutions have gotten a bit more challenging, really prodding companies, companies are less willing to roll over and put it to a vote. So in the past, companies would just say, sure, whatever, we'll do what you want. Let's not put this to a vote. I think so you get a bit more contentious now. But I think the flip side, sometimes you see very clear cases where investors say, look, you really should be doing this. Things like sustainability reporting, often those shareholder resolutions, if not passed, get very high, very close to passing. So I think it's very, very clear that that's accepted practice, or companies should be doing it. So I think you keep seeing pressure on that. And increasingly what we saw this past year was looking at gender, looking at particularly the pay gap, gender pay gaps, a number of resolutions on that, and already resolutions being filed particularly at financial companies, so banks. This past year, number of tech companies. So I think it's increasingly an issue. Again, it's going to come down to investors understand that these are issues for company performance. They expect to have boards, operations that really promote creating long-term value.
Great. So, looking at it, you provide quite a bit of third-party data, and is it equally important to as a company to provide data to those third parties that then filter it, and is it important also to provide it directly to Bloomberg, or is one more important than the other? Direct information from the company versus the third-party vetted information.
So when you say like the third-party scores from Sustainalytics for BecoSam?
Yes.
I mean, sort of just like financial data that you'll get on the terminal. So we have the data that we collect at Bloomberg from company reports, but at the same time, we'll have analyst recommendation, buy-sell recommendations that we collect and come up with. So, I think it's pulling that information from those different spheres and putting it into one place. So whether third-party ESG scores are good or bad or better, the point is they're out there. And so we're trying to make it as easy as possible for investors and corporates to find that information. Now, in terms of the collecting the data, so we collect it all ourselves, and we have our own team that goes through, pull that information, and sort of unlike financial data, like in the US, because there's very clear rules and XBRL tagging for SEC filings, no human being has to touch it at Bloomberg. When it comes to ESG, there are no rules. And so we actually have to spend a lot of time looking at data, making sure it covers the company's global operations before we can put it into our system. And one of the things that we've been saying quietly, but trying to a bit more loudly now, is we're going to stop accepting data from companies directly. So sometimes in the past, companies could send us an Excel sheet with their data. But one of the things that we found is if companies just sent us data, it wasn't the same as publishing it, right? So if it goes into a annual report or sustainability report, usually a number of people have to check it and approve it before it gets publicly available. So it's much more likely to be correct. If it just goes into an Excel sheet and emailed to us directly, we more frequently found errors with the data. So we're going to stop accepting. But the other point is, we really want companies reporting this information. We want it to be publicly out there. We really want to prod companies to provide that data publicly.
Great. Well, that brings us then, Susan, to the idea of building a more effective ESG narrative. If you're as a company, you're getting more of this information about your environmental, social, and governance performance out in the public. How do you do it in a manner that connects with those investors who are interested, and not only connects with them, but influences them in a positive way?
Mm-hmm. Well, I think the first thing to do is to recognize, and I think Gregory's made that clear too, is that investors are looking all over the place for ESG information about your company. Because there isn't a standard, you can't just go to the securities filings, although that is one of the popular places they'll look. They seek your information everywhere. So they'll look at the press, they'll look at your CSR report, they'll look at what's on your company website, and then they compare that against what's showing up in your circulars and your securities filings. And they have, generally, the sophisticated investors have in-house research teams, and they look at all that third-party data that's also provided by Bloomberg. So it's a real soup to nuts right now, and you have to be aware of that and determine, how you're going to address that reality. So some practical steps that I can suggest right now, especially as you're thinking about your next earnings report and how you're going to respond to ESG information requirements or demands from investors, is most companies have data and policies already that they're using to make their management decisions. So it must be information that they have enough a sense of confidence about, that they're making their own internal management decisions about, but they're not releasing it to the market, either because they don't think the market cares or is tracking that stuff. And so this is sort of the wake-up call that the market does care and would like to see that information. I have seen companies who have simply released information they already had and have confidence in, and they've seen their Bloomberg ESG scores bounce within a few days. So that's a really quick step. Look at what you've already got and share it. Ron mentioned boilerplate, and this is something that needs to be recognized, is that boilerplate is not free insurance when you're talking about material issues. It's actually, there are studies now that suggest that analysts are factoring in a risk premium for companies that identify something that's material, but reference it only with boilerplate information, because it suggests to the analysts that, they see this as material, but they don't really have anything to say about it just yet, so they must not have a management approach. This example that you're looking at here on the left side is the same company disclosing in 2014 on an issue with respect to climate change and water. And in 2015, they got much more specific. They provided metrics. They talked about management's approach to that issue. And that's what investors are looking for. So it's important to not think that boilerplate is ESG disclosure. It just isn't. So the third step that you can take right off the bat is walk across the aisle and get to know your sustainability people. And the sustainability folks have to also walk across the aisle and get to know IR, because we already know that investors are looking at all of these different channels for sources of information. And this is just an example. It's not unusual at all for public companies to have very different approaches to talking about the very same subjects in different channels. And this is a red flag to investors. If there's boilerplate information in your 10K, but very specific information in your CSR report, it would suggest to an investor that management isn't really taking this seriously and doesn't really have internal controls or hasn't embedded it into their business operations or strategies. So there's an opportunity to pretty quickly look at where your investors are getting information and working towards alignment across all of these channels. I will note that the SEC has identified that this is something to be aware of, and in fact the SEC does look at all of your disclosures, not just your 10Ks and your annual reports. They look at all this information and they say too, what are these gaps about, and they're talking about what needs to be done to address these gaps. So that's sort of the immediate stuff that can be done. Now there's this, what do you do going forward? What's the medium-term, long-term plan for ESG communications? And I'd like to suggest 5 steps you can take to creating a more robust platform and approach to ESG communications. The first thing to do is understand who your investors are. You know, ESG investors are not a homogeneous group. They have different motivations, different sensitivities, time horizons, just like all your other investors. So it's important to say, take the top 20, 25 investors that you have and gain an understanding of their use of sustainability information. There are primary and secondary research tools that can be applied here so that you can really ask some questions and get a very good map of who these people are, how they're making their ESG decisions, and you know, understanding whether or not you have, do you even know if you have any investors who are signed on to any of these very high-profile investor initiatives such as the UN PRI, which is the UN Principles for Sustainable Investing, where investors, asset owners, and investment managers sign on to a commitment to integrate ESG into their investment decisions. Do you have any of those investors in your pool? And if you don't, why not? And then the next question would be, you know, looking at your peers. Do your peers have some of those people investing in them and not you? These are really important, I think, sort of ground level research steps to take to understand where to go next. And so the next step would be to do some benchmarking on your ESG disclosure performance versus your peers. There's a bunch of information as you can find on Bloomberg. There's CDP disclosure scores. There's all the third-party disclosures and rankings. And then there's just looking at the documents that are out there. How do your documents look? What are you disclosing versus what your peers are disclosing in your sustainability reports, your financial filings, your websites, etc. SASB has been mentioned a few times, and I just want to touch on this because I think it really is a great resource for issuers now. The Sustainable Accounting Standards Board, they've been at work for a number of years developing standards sector by sector for companies to use to guide them in terms of determining what to disclose and how to disclose it. They only released their provisional standards this year. They started in January 2016, and they've released all of their industry standards now. But already, within less than a year of these draft standards, 43% of investors have said SASB is their go-to, and this is what they would prefer issuers use to guide them, as compared to the GRI, which got 21% response from investors. So you definitely want to know about SASB and look at all of the guidances that they provide. And here's why investors like SASB, because SASB has focused, first of all, on what investors should care about, and they've taken that sector-by-sector approach. So you can see how practical it gets. They identify for airlines that there are 4 material topics. For meat and dairy, there's 10 topics that issuers need to look at and make a decision about whether those topics are material to their business, and if so, how, and what will they disclose. Typically, the sectors, the industries have between 3 and 5 material topics, so meat and dairy is at the high end in terms of number of topics that could be material. And SASB has also taken a good look at how topics show up differently in different sectors. So if you take climate change, for example, and see how SASB suggests a material topic would be for real estate, the energy efficiency of the buildings that the company holds. And then they provide a suggestion in terms of what the metrics should be for reporting on that. And in contrast, if you look at banking and insurance, the climate change impact would show up as how the assets of that bank might be vulnerable to climate change. And then they provide a recommended metric on how to report on that. So step 4 is determining what you're ready to disclose now. And I would say as a rule of thumb, if you find that you're reaching for the boilerplate, you're not ready to disclose. So then what are the best practices to get ready to disclose? I think that what I've been hearing is that one way to overcome the challenge of getting internal sort of capacity to report is to help the internal organization understand the language of ESG and also adapt environmental and social governance to the language of what you're already tracking and reporting on and using to guide your business decisions. Most companies are managing these factors. They just don't recognize that it falls under the ESG labels for what investors are looking for. Another best practice is to get your board on board and your executive team. So I'm hearing more and more interest and requests for board briefings, executive briefings on ESG, really giving them sort of the one-on-one so that they can be comfortable with what this is all about and recognize that ESG is already what companies are managing. We just have to get better at understanding and reporting out to the market. And another key issue around being ready to disclose is implementing data collection on material issues that you can feel confident about and turn around and share with the market. So I think if you get your executive and board on board, you're going to have support for putting the resources behind auditable data collection. And then the final step is doing that communicating. And I don't think you have to wait till you get all of these good things in place. If you have ESG content, if you're issuing a sustainability report in any way, there's no reason not to map that back to ESG and language and put that in your investor communications now. Put it on your investor page. And if you don't have anything to report, at least state that this is something that's on the radar screen and that you're putting programs in place to be able to report. Socializing ESG internally and starting to talk informally about ESG is an important step in getting people comfortable with the language. Embedding ESG language in your sustainability report so that when investors are looking in the sustainability report for that information, they see that you are adopting that framework for reporting. And the end game is eventually to get to where you are including ESG in your investor presentations, in your filings. And I'll just end with, it's really important to recognize that this isn't a once a year check-in, that just like financial data is updated regularly and anything that materially changes the business forward-looking opportunities is reported out. Investors are saying they want to see this information being shared dynamically and not just once a year.
And Susan, can you explain a little bit, you mentioned embedding ESG language into reporting. Can you talk a little bit more about what is ESG language? Because I would assume there are certain people on the webinar might think that their boilerplate does incorporate that kind of language. So can you expand on, the difference between ESG language and boilerplate language?
Well, ESG language really reflects understanding what exactly is material in the operation of your business, the future risk and opportunities of your business, what you're measuring to assist the organization in managing that issue, and reporting that in your sustainability reports, rather than boilerplate that really could apply to any company in any sector, or certainly any company in your sector.
All right, great. Those are awesome tips, and now I want to open up to questions. We've been receiving some questions, and thank you to those participants who have sent their questions in. Just as a reminder, if you go to that box that says Q&A down in the bottom right-hand corner, you can submit questions to us, and we'll try to get to as many as we can. One of the early ones that came in was asking what companies are considered best in class in ESG reporting. I'll answer that one from my perspective. One that I'm very familiar with is CEMEX, CEMEX. They're a global concrete manufacturer. They cover pretty much the entire gambit of transparency in ESG issues, set goals, measure against those goals, and are not reluctant to share information even when perhaps it's not seen as positive internally. They do disclose externally their performance in many of the ESG categories. Greg, I'd ask you that question. What companies are considered best in class in ESG reporting from your perspective?
Yeah, I think one of the things I would stress is it's not simply a matter of how much data a company reports. I mean, I think really what we're looking at within Bloomberg Intelligence, building off the work of SASB and what investors want, it's material issues. So it's making sure that companies report on the issues and data that matter to them, and in terms of companies that are doing very well, I think sort of without naming names, what we try to do is within our industry ESG primers that we've put on Bloomberg Intelligence is actually pull that out and make it very clear where we see the key indicators, companies are disclosing it. And what we found is, so CEMEX, within the cement sector, a lot of companies there, because there's a high environmental impact as well as safety issues, do an excellent job. If you look at oil and gas companies, most of them do, again, a very good job, because there's been a lot of investor pressure to provide that information. As you saw my slide on the food sector, it starts to vary a bit. And so someone like Unilever, which has been very much out in the fore in these issues, does a very good job reporting. Inditex, H&M, particularly H&M, does a very good job, and not only in terms of data, but also why does it matter to a company's strategy. A couple of years ago, I believe it was the CFO of H&M was asked on an investor call by an investor about investment in sustainability and organic cotton and all of that, and he said it's going to cost a lot of money, but he thinks it's an investment. And I think that's what customers are going to want going forward. And so I think it's really being able to articulate that in terms of data and the strategy that distinguishes leaders from not leaders.
Great. And Susan, do you have any you would throw out there as far as best in class when it comes to ESG reporting?
I do, and I think every sector has had several leaders, and and it really comes down to, it really depends on what investor you're talking about and what they're looking for in terms of information. But what I've found, so if you really want to look at the leading edge of leaders, look at who has already started to reference SASB in their sustainability reports. And there's about a dozen of them now: HP, Delta, SAP, Barclays, State Street, Praxair, Microsoft, Owens Corning, ING, Volvo. These are companies that have already, even in the first year of SASB releasing provisional standards, started to reference and recognize SASB in the sustainability report. So if they've already got their game on well enough to recognize SASB and signal to the market that they're going in that direction, I would say that their reporting is going to be pretty strong.
Great. Well, this is an interesting question. The importance being placed, the increasing importance being placed on ESG by investors. What is driving that? Is it risk-based? Is it value creation? Why are investors so interested in ESG disclosure? Greg, I'll throw that to you first.
Yeah, I mean, at the end of the day, I think one, there's been a push from a number of big pension funds, people like CalPERS and CalSTRS, state pension funds in California, New York City, New York State, as well as in Europe, like Norges Bank, the largest sovereign wealth fund in the world. Really sort of, they think it's important to their performance, and to financial returns, and as well as issues that they're concerned with. And if people with a lot of money care about it, the people with the money, investors, asset managers start to care. And I think there's been that trickle down, one from the top, I think, as well as some investors seeing value when you see something like a Volkswagen or a BP, or even a Wells Fargo, looking at issues like corporate governance, strategy. And I think it becomes clearer and clearer that these issues matter to financial performance and particularly being able to steer clear of potential minefields.
Susan, what's your perspective on what's driving the interest in ESG disclosure?
Yeah, I think it's the values investors who are, whether they're large pension funds or the family offices and everything in between, who are looking to align values as an environmental and social impact with their investment practices, especially now that they see that there really isn't a trade-off between performance and aligning values. So there's that group, the values group, and then there's the value-driven group who are more traditional investors who see ESG as a way to evaluate management quality. Does management really understand the full spectrum of risks and opportunities ahead of them? And ESG is that more forward-looking way of answering that question versus financial reporting that is historical reporting or moment-in-time reporting.
Now, Greg, you mentioned something that I thought was interesting is you highlighted the extractive industries, as industries are doing a good job of reporting. And, there's a question that kind of relates to that, which is, if you're in an industry that is seen as not perhaps being as environmentally friendly, is it even really that important to disclose ESG? Because those investors who care probably aren't looking at your industry anyway. What would your response to that be?
I think it's a very small segment of the investor base that's going to completely divest of an industry. So I think at the end of the day, it really behooves companies to make it very clear what is their strategy, how are they addressing these issues, what's the performance, all of that. And not every company does well, even when it has the policies and data in place, but it's making that as transparent as possible. Because the vast majority of investors are going to invest across sectors.
So essentially, if you're the best within a sector, if somebody's diversifying their portfolio, you still win because the final screen perhaps is the ESG.
Yeah, and I think it's an important point. I think very, very few investors use ESG as their main screen. There are some ethical investors and that kind of thing. But generally, it's whatever makes a company a good financial investment. That's what investors are looking for. And then ESG becomes an extra lens, an additional factor on top of it.
Perhaps the tiebreaker in the end.
Yeah, no, often I think that is the case.
Yeah. Here's an interesting question. How is the ESG data that companies are reporting audited and validated? Susan, do you want to take that?
Yeah. There's a number of ways that's done. There's different auditing frameworks that are recognized for validating ESG data. You can have the entire report assured, or you can have just selected KPIs verified. And there are suppliers that provide that service. You can have if it's GHGs, there are supply houses that can verify your GHG audit trail. And then there are a number of organizations, including the accounting firms, that do full assurance of reports. So it's a whole world unto itself, and there are established best practices on how to do that. But it really does come down to making sure that the way that you track data is auditable. And less is it acceptable to track data just using Excel sheets, because it's so easy for someone to hit the wrong button and significantly change what that number looks like. So in terms of a longer term plan, if you don't have data in an auditable format yet, looking at third-party tools, software tools that help you really track data in a secure way would be an important step.
And Greg, again, looking at those third parties, is there a priority? If a company is looking at getting more involved in providing data to some of these third parties like CDP, is there a hierarchy in terms of how Bloomberg views those? Where would you start if you were just starting out reporting through third parties?
I mean, in terms of my bias, I think companies should make it publicly available so organizations like Bloomberg, but also everyone can get the data. I think sometimes with third-party initiatives, the data isn't available to all users. But then practically, I think it's a matter of where a company sees interest, where they're getting feedback, from in investor relations, from investors saying, we don't see your score on this, or we expect you to do better on this ranking. So yeah, I mean, I think make it publicly available first and foremost, and then figure out, which are the initiatives that people are asking you about the most.
Okay. And here's kind of a flip side of the conversation we had about extractive industry companies, but what about online, and internet companies, companies in that kind of space? Is it more difficult for them to report on ESG issues in your estimations? And Susan, you want to comment on that?
No, I don't think it's more difficult. It comes down to determining what's material. And so I would say, internet companies, what could be material for them would be workplace practices, diversity in the workplace, and also vulnerability to climate change in terms of, where their servers are housed, and, what they're doing to manage data integrity, and, all the concerns around cyber hacking, and those are all related to ESG. And so it may not be about, paper recycling, and it won't be about paper recycling for sure. It's about those other issues in social and governance quadrants that would be material to companies like that.
And would SASB, would that be an industry that they would have material topics listed, going back to what you presented? I think you compared two industries, airlines and the meat and dairy industry. Do they cover a vast majority of the industries out there?
They cover the entire U.S. economy, is the way they describe it. So 79 industries are covered, and you can go into SASB's website and type in a company name, and it'll tell you which industry standard that company falls under, as long as it's publicly traded.
Great. And Greg, one of your areas that you look at is worker safety. And I feel like a lot of the information, when we talk about ESG, it does kind of skew towards climate change, and I know that's a big part of your job too, with water scarcity and climate change, and more environmental. But can you talk about the importance of the social issues, worker safety being one of those, and do you see better or worse quality data, or the same, coming out of companies when it relates to social issues?
Yeah, no, I think social is generally much harder to quantify, and as well as what is social ethical for different investors, different people, varies. But I think something like diversity, at least when it comes to gender diversity, it's relatively easy. And there's been a big push, as I mentioned, especially around issues like gender pay gap. If you look at safety, again, that's easier to quantify. And but the problem that we find with, just so you have with climate change, a lot of issues, companies have to report on safety incidents at a site level kind of thing to OSHA, but they don't necessarily roll it up and report across their global operations. Or even for, even if it's companies just domestically focused, what the safety performance is, things like lost time incident rate, total recordable incident rate, fatality rate. And so that's the kind of thing where most companies probably have that data, and so they should really put it out there. And I think sort of safety is one of these things, not just the BP extreme example of a very costly the Gulf of Mexico oil spill, but even just sort of what we see is just sort of higher levels of safety incidents. That just has an impact in terms of operating efficiency, downtimes, potential fines, lawsuits. So even if you're not having those major catastrophic accidents, sort of that low-level impact on performance can hurt companies.
I think that where things aren't measurable, there's still the opportunity to share policies. So where, you can't come up with hard numbers. I think establishing what the policy is and making that available to investors helps investors understand that you've got your eye on it, and you have a plan and a procedure in place to manage the issue.
Right, but I do think there's sometimes resistance, right? When let's say you're focused on worker safety, it is very difficult to report number of fatalities, and to your point, Greg, that has to be reported to the government. But I think when it comes down to putting in a financial report or a CSR report, there's resistance to that. What would be your message to folks who have to go sell the idea that this should be included in these public reports?
I mean, at the end of the day, just look what your peers are doing. We've collected that data, and if you look at for larger market cap companies, they're very likely to report it. I mean, as well as organizations like SASB and anybody else will tell you should do it. But if your peers are doing it, it probably makes sense for you to do it as well too.
Right, and that gets back to Susan's earlier point about the importance of benchmarking. That might be one way to open some eyes and get the resistance to soften a bit. I think this will be the last question, and this ties back, Susan, to one of your points about collaboration. And it's what we're talking about is a bit of a hybrid, right? It falls in financial, but it also falls in the realm of sustainability. And for many companies, those reports are separate. There's a CSR report and there's a financial. Not many are doing integrated at this point. And the responsibilities oftentimes fall in different sectors as well. So what is your advice to those who are on the call here today on how do you find the budget and find the attention and collaborate to get the data to effectively communicate ESG issues to this investor audience that really does care?
Yeah. Well, what I'm seeing in conversations I'm having with clients is that it does start with a conversation between CSR people and IR people, and often they don't know each other, or certainly don't know each other well enough, and have probably not even done much work together. So it takes initiative on one side or the other to pick up the phone or cross the aisle and have a meeting and share, because it's different language, it's different expertise, and you need all of that expertise to do this well. So someone's got to take the lead here and cause a meeting to happen, and then discuss what it is you know, what you don't know, and share the knowledge. Every organization is going to have a different way to break through that then and create either a joint team, some shared budget. But you can't lose sight of the fact that if you don't have your senior executives comfortable with ESG, often it's really a matter, they're uncomfortable. They feel awkward with the language. So figuring out how to translate or identify what management's already measuring and making management decisions on, and say, look, see, that falls under E, that's S, that's G, and giving them the confidence that they actually do understand this information. They just use different language for it. At the board level, really, the board needs to be brought along, and when you have board and senior management on side, then the resources will fall into place.
Great. And with that, I end the webinar. To our audience, thank you so much for your attention. To our guests, thank you so much for your insight. If anyone has any more questions, you please feel free to reach out to myself or to Susan via our email addresses there, and feel free also to check out GNS Business Communications. I hope everyone has a pleasant afternoon and a happy holidays. Thank you for joining us.